What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is February 24th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to talk about the fundamental dynamic that is going to answer the question whether or not we are in another bull market for Bitcoin's price. And I want to go ahead and emphasize that this is the dynamic that is going to determine whether or not altcoins are coming back in any fashion, and if the broader stock market and the broader asset markets as a whole are going to return to higher valuations in the long term. We've got a lot of things to dive into today's video, so if you enjoy the rambling, drop a like. It's one of the best ways you can support the channel. And let's go ahead and kick off the rambling. All right, so I want to go ahead and focus in on the broader trends. So we're going to be diving into the weekly charts here, talking about some big dynamics here. And I just want to go ahead and emphasize that I understand a lot of people are feeling the FOMO right now. Even looking at the weekly time frame, we've got some positive signs on our trend indicators since the start of January, as we've had a major move throughout January and February, pressing back up against that 200 week. And while price action is definitely looking interesting, we still have a couple steps to go before we would actually confirm a bull market. So this is where I want to kind of tie into discussing this topic of what fundamentally is going to determine whether or not Bitcoin and other risk-on assets can move up long term. And that has to go with a major macro question, and that is whether or not inflation is done with. I know everyone is probably tired about hearing about inflation, that it seems like the worst is behind us. But as we saw in last month's consumer price index, the CPI, we had our biggest month since back in June when it came to the monthly increase in the CPI of about 0.52%. This is not negligible. On an annualized basis, you're starting to talk about a 6% annualized inflation rate if we were to keep at this pace for the next 12 months. Now, am I saying that we're exactly heading that way? No. If the Fed does the right thing, these kind of months will be a blip that happen from time to time, and the broader trend will be zero increase in inflation over a month, or maybe just 0.1 or 0.2%, as it had been for some of the prior months, like back in December and November. However, we saw this play out because the Federal Reserve talked soft, or more specifically, that the markets didn't buy what the Fed was saying. Now we're seeing bond prices and all of the major metrics that we rely on signaling, as they have been for the past couple of weeks, that the Fed is serious, that the Fed is going to continue tightening. So long as the Fed does that, right, and the Fed moves towards that, that is going to be a step in the right direction. Now, even though the markets are starting to reprice in that the Fed is going to be tightening, there's something that's quite concerning that's still happening, irrespective of whether or not the Fed actually loosens financial conditions and starts to, cut back on interest rate increases or cut back on their balance sheet reduction program. And that is the price of oil. Now, this is where commodity markets can be a huge benefit for you when it comes to predicting long-term trends. If we understand how important oil is to the broader trend of inflation, not just in the direct energy cost of gasoline and other petrochemical products, but more specifically, how oil as a cost impacts the variety of different costs in our day-to-day lives through a variety of industries you just may never think about, from transportation, goods and services. Once we understand that the trend of oil is deterministic on getting inflation down, that unless oil really starts to crater lower and confirm a continued downtrend from its trend back in June of 2022, until we realize a long-term breakdown of that 200-week moving average, the job of cooling inflation is not done yet. And therefore, Bitcoin and other risk-on assets are going to struggle to have an upward trend. Now, bear in mind, the Fed is aggressively raising its target rate at its fastest rate in history. We've never seen such an expansion of the federal funds rate. And still, with this tightening and contraction of monetary policy, oil is still holding afloat above that 200-week EMA. It's not even coming down to the standard moving average. That is a very worrying sign. Now, another dynamic that is also very concerning is that as we have started to see, one of the biggest benefiting factors for oil over the past couple of months, or really more specifically towards the US and the broader global economy, getting inflation down to its key targets, so monetary policy doesn't have to be so constrictive, is the US Strategic Petroleum Reserve. Now, during the past year, the Biden administration had utilized this as a tool, as it was built and intended intended for to ideally reduce the overall gap between supply and demand in the market. So the United States government has these strategic petroleum reserves that they can unload into the market to increase supply and utilize as a negotiation tool against countries within organizations like OPEC Plus, Russia, other different types of entities across the world who are likely trying to take advantage of producing less supply to lead an even bigger gap between supply and demand, right? It's basic, supply and demand economics here. If we can deplete the strategic petroleum reserve, that adds more supply, therefore weakening price and allowing us to reach our targets. Well, here's something that's really concerning, right? People tend to talk about the strategic petroleum reserve when it was depleting. But one thing a lot of people haven't noticed is that since the start of January, we have not been depleting it. And for me, this is something that I've wanted to see. I wanted to see more specifically how price would start to play out when we see the depletion of the petroleum reserve stopping, right? What happens when we stop giving that boost of additional supply to the market, where every week we're adding 1 million, maybe a couple million barrels of oil to the global markets? Well, since then, if we take a look at the daily or weekly time frame, oil has been making slightly higher lows, and it is holding afloat on that 200-week. Just the other day, it didn't even come down to touch that. And we see that oil moves in these consistent trends back down to the 200-week. This time around, not even touching it. Now, it's not making significantly higher lows. I'll go ahead and say that. That's definitely a positive sign. But it is a clear, definitive sign that investors, more specifically, buyers across the world, are potentially preparing for something much worse. They are preparing whether or not oil is going to get back to 3 digits. The U.S. Strategic Petroleum Reserve only works for so long, even if they turn it back on eventually. I think the United States is probably doing what it does best here, which is trying to have some kind of negotiation weight in the long term in order to be able to sustain a further downtrend. They're trying to play their cards right. And it's a difficult task, because if we essentially do not see more producers coming to the market, and there is no more oil in that strategic petroleum reserve to deplete onto the open market. We already went through practically half of those reserves back in 2022. We need to understand that the game of inflation is a long-term one. The decade of inflation that happened in the 70s could very well happen this time around if we don't play our cards right. If we do not fix the issue and the imbalance between supply and demand and the monetary stimulus that has kept that demand so high. We have doubled the base monetary supply, and that is going to have ramifications when it comes to oil, natural gas, property prices, everything that plays a role in our cost of living. Now, one other important thing to note is that as of last week, although we don't have the data just yet, as there's a bit of a lag on the data for the U.S. Strategic Petroleum Reserve, back on February 17th, this is where we last have the data. We can see that on the 14th, the United States has announced that they're going to continue depleting that petroleum reserve. Now, I think this is definitely an important step in the short term to get us below that 200-week and to confirm the trend to the downside. But again, this can only affect oil's price for so long. And eventually, in order to have that negotiating weight, there are periods of time where we're going to likely have to add to the strategic petroleum reserve to have that additional weight when we need it most to weigh down prices. So again, we're going to have to see how this plays out here. But either way, we only have so much firing power. And I think this is a clear sign since back in January that the U.S. is trying to test whether or not it needs to deploy that firing power. I think if it was going to play it effectively, it would have used a bit more in the short term and crushed the trend so that the 200-week could start serving as resistance. Trust me, guys, things like this do matter when it comes to the overall trend here, because you do have investors, you do have long-term stakeholders who are preparing and stacking up energy, players like Europe that are trying to counteract this geopolitical tension between Russia, which was previously one of its largest providers and producers of oil and natural gas. So there is a key dynamic we need to keep in mind here of that. But going back here to the topic around crypto, right? If we don't have inflation done, I wanted to go ahead and spend some time to talk about CryptoQuant. They're our data science partner here on the DataDash channel. And on top of that, they've got a really great board that you guys can access to for free, which you guys can access down below in the description, where it's got all of my favorite data science models that I keep track of. There's already hundreds of you checking out the DataDash CryptoQuant Insights dashboard, and there are 3 key charts that I wanted to share with you guys here today, all of which, for me personally, according to history, have not shown the even traditional signs of real capitulation in a Bitcoin bear market. Now again, I really want to bring this topic back into the conversation. We have not seen even the typical corrective or capitulative signs of a traditional Bitcoin bear market. But Bitcoin has never lived through a proper 30-50% recession in equities, right? What is it going to look like for Bitcoin as a risk-on asset during that period of time? I think it's going to be even more bloody, or at a minimum, typical to the traditional correction we've seen in Bitcoin bear markets. Take a look at the net unrealized profit or loss. We've had this big spring up into the green area. A lot of people convinced that it's the start of the next bull market, but important thing to note here is that the capitulative low that we had was higher than every single prior bear market. That to me doesn't sound right. And again, I think a lot of people are thinking that this is just another bear market and it's going to get better and better over time, and we're not going to see a new low retest in this range. I got to tell you guys, this doesn't look like a traditional reversal in a Bitcoin bear market, not in price, and also in the time that was spent here in this capitulative period, especially considering the macro environment, which cannot be ignored. It has a major impact on the monetary flows depending on what the Fed is going to be doing with monetary supply. And right now, they are clear about continuing to tighten to get inflation down. How about the next step here, the Powell multiple, which tracks, again, the amount of Bitcoin being minted essentially, or the dollar value of that new Bitcoin over a 365-day moving average. As you can see, since back in June, that metric has been moving higher, and we never really got a low retest like we had in 2011, similar to what we almost had in 2015 and in 2018 during traditional Bitcoin bear markets. Sure, we went into the green channel, but we did not see that capitulative move to the downside. And I would expect that we are going to see some heavy minor capitulation considering the issues with Celsius, the issues with a whole range of miners that got overexposed and are burning through capital right now. There will eventually need to be a pretty heightened capitulation and therefore likely sell-side pressure in Bitcoin. I think we're starting to see that in the sense of the distribution of price. People are taking advantage of the higher prices here, getting ready to stomach the potential downside. But the last thing that really signals it home for me is taking a look at the supply and profit and our specific data science model of taking a look at the 30-day average for this metric. And as we can see, the low we had was around 49 points, whereas the vast majority of bear markets came down to a range between 47 and all the way down to 42 to 44 points. So I got to tell you guys, again, whether I'm looking at the data science models for cryptocurrencies, whether I'm looking at price action itself, or more specifically, the inflationary dynamic that cannot be ignored, that the Fed cannot just sit on the sidelines and not address. If it doesn't do it this week or this year, then it is going to have to do it eventually. We are going to see a brutal, drawn out, difficult period of time for Bitcoin. And this is why, again, I don't have any serious FOMO when it comes to price. Price is still below, right, roughly where we took our positions out of the market, around 24, 25K when we went into cash. We didn't miss anything, right? And this is, again, the important reason why it's best not to chase every single trade and realize the reality of where we are now, that the dynamic has shifted. We are not in a typical Bitcoin bull market. At least it's most likely that we're not. We are still trending below that 200-week. The first time in history we have ever been suspended below the 200-week moving average for Bitcoin for so long. And it's in a period of time where the Fed is reducing its balance sheet, dumping assets onto the open market, and absorbing excess liquidity. The complete opposite of what we saw over the last decade. Well, last decade, that easy money is what propelled assets that were risk on like Bitcoin. In the next 10 years, it is going to be the dynamic that crushes Bitcoin and other risk on assets until the job is done. It probably won't be 10 years if the Fed does things right, But if they keep kicking the can down the road, like the Fed did back in the 70s, we've got a lot of pain coming in the future with a money supply that's 2 times as big as it was before. Anyways, that's it for today's video, guys. I rambled on a good amount. If you enjoyed this video, drop a like and definitely consider checking out the Crypto Quant dashboard. It's a great tool you can add to your arsenal when you're doing your analytics and measurements of the market. But that's it for today's video. Thank you all so much for tuning in, and I'll see you all in the next one. Take care, everyone.